All right. Good evening, traders. So happy you joined me this evening for our monthly members exclusive bonus teaching live session. I am actually getting ready to go out of town to celebrate my husband and I's 35th wedding anniversary. We are doing a trip all around Europe, mainly the Baltic Sea countries, and very excited about that. But I wanted to do July's members only session before I left and choosing the topic of Fibonacci's and how I use Fibonacci's to enter, target, and stay in trades. So I'm going to first lay out these slides for you so you'll have an idea. And also, if you want to take screenshots of them or rewatch the video to see exactly the strategy I use for Fibonacci's, these will all be available to you. And then when I am done with the slides, I'm going to go to live charts and show you in real time how I use Fibonacci. So we'll do that together on live charts. If you don't mind, go ahead and take a moment, hit the like button. Even though this is a members only video and only available to those of you that are members of the channel, it still helps with the algorithm. YouTube pays attention to everything, so it will help me out if you would hit the like button. So today I want to walk you through one of the tools that I use on every single chart. Regardless of whether I'm looking at a swing trade, a day trade, or a long-term position. And that tool is a Fibonacci retracement. Now, if you've heard the word Fibonacci before and you immediately thought that sounds complicated or I tried it once and it didn't make sense, I want you to stay with me because what I'm going to show you today is not the academic version of Fibonacci. I'm not going to talk about spirals in nature or the golden ratio in architecture. I'm going to show you exactly how I draw it, exactly what levels I use, and exactly what I'm watching for at those levels. It'll be practical, specific, and repeatable. By the end of the video, you're going to understand not just what Fibonacci levels are, but why the market respects them, how to read market conditions to decide which zone to use for your entry, how to set targets using a second Fibonacci draw, and how to know when to stay in a trade that's working and when to pull out the extension. So, I'm going to go over all of this over the next 30 minutes, then we will dive in live charts. But before I show you a single drawing on a chart, I want to spend some real time on why Fibonacci works. Because if you understand the reason it works, you will use it with conviction. And using a tool with conviction, knowing why it works, is completely different from hoping a level works. Let me start here. The Fibonacci sequence, the mathematical foundation, goes back to the 13th century. A mathematician named Leonardo da Pisa, known as Fibonacci, identified a sequence of numbers where each number is the sum of the two before it. 1 and 1 is 2, 2 and 3 are 5, etc., etc., on and on. And what Fibonacci discovered, and what mathematicians since have confirmed repeatedly, is that the ratios derived from this sequence appear constantly in nature. The growth of a nebulous shell, the spiral of a galaxy, the branching of trees, the proportions of the human body. The ratio of 61.8%, which comes from dividing any number in the sequence by the one that follows it, is called the golden ratio, and it shows up everywhere. Now, Why does this matter for trading? Here's the honest answer. It's two reasons. The first reason is human behavior. Markets are made of decisions, buy decisions and sell decisions. And the psychology of those decisions, how far people allow a move to retrace before they step back in, or how far they let a move extend before they take profits, naturally gravitates towards these Fibonacci proportions. When a market moves from point A to point B, traders instinctively react at roughly 1/4 of the move, 1/3 of the move, 1/2, 2/3, those proportions. 23.6%, 38.2%, 50%, 61.8% are where the market's natural equilibrium tends to pause. The second reason is institutional reinforcement. The biggest money in this market, the hedge funds, the algorithmic traders, the institutional desks, they program these levels as trigger points. When a major institution sets a buy order at a 618, a 618 retracement of a move, and other institutions do the same thing because they're following the same technical framework, you get clusters of capital setting at the same level. And when enough capital sits at the same level, the level creates its own gravity. It becomes self-reinforcing. And here's what I want you to understand about how this changes the way that you use these levels. You are not drawing Fibonacci levels as a prediction of where price will go. You are drawing them as a map of where significant capital is likely resting. When price approaches a key level, you're watching to see if that capital shows up. If it does, you have confluence. If the level fails cleanly, you move to the next one. That is the foundation. Fibonacci works because human psychology and institutional capital both cluster around these ratios. Now, let me show you exactly how I draw it and how I use it. All right, here's method number one. And this is the one I use most often because this is where you find the cleanest setups with the best risk to reward. The concept for method one is a trending market. So, what's a trending market? Price is making consistent higher highs and higher lows, or consistent lower highs and lower lows if you're trading a downtrend. The trend is established, it's not debatable. You are looking for a pullback to enter with the trend. So, method number one is talking about how I use Fibonacci in trending markets. Here's how I draw the Fibonacci in a trending market. For an uptrend, I anchor the tool at the most recent significant swing low and drag it up to the most recent significant swing high. If you have it drawn correctly, in an uptrend, 0 is at the high and 100 is at the low. The retracement levels 23.6, 38.2, 50, 618, they fall between 0 and 100. That is my map for where buyers are likely to step in on a pullback. Now, in a trending market, the entry zone that I'm watching first is the 23.6 to the 38.2 level, not just the 38.2. It's the zone between those two levels. That range is where strong trend momentum typically finds its buyers on pullbacks in a trending market. Why this zone specifically? Because in a strong trend, buyers are not waiting for deep pullbacks. They know the trend is intact and they want in. They buy shallow at the first meaningful retracement because they do not want to miss a continuation. Waiting for a deeper pullback in a strong trending market often means waiting for a setup that's never going to come. And what I'm watching for when price enters the 23.6 to the 38.2 zone, I'm not just entering because price touched the zone. I'm watching for confirmation that buyers are stepping in. Specifically, I want to see price slow down inside the zone. I want to see absorption candles, small bodies with wicks, indecision candles. That signals that the selling momentum is exhausting. I'm looking for higher lows for uptrending markets or lower highs in downtrending markets. Now, if you have been around, if you're trading with me live in the trading room at Simpler Trading, where I trade live every single day, you know my confirmation process, or you should know the confirmation process. That is the process that I use when price pulls back to this Fibonacci zone. The stop on a trending market entry sets below the 38.2 level with a close-based stop on your trade time frame. A wick below 38.2 is the market probing. A candle close below 38.2 tells me that the pullback is deeper than a trending market should produce, and the trend momentum may be weakening, and I exit for a loss cleanly. Now let's talk about method number 2, which is choppy market entries. All right? And this is the one that I think saves traders more money than any other adjustment that they can make, because most traders use the same Fibonacci entry zone regardless of what the market is doing, and that is a significant problem. Here is the core principle. The level at which buyers and sellers step in is not fixed. It changes based on market conditions. In a strong trend, buyers are aggressive. They buy shallow. In a choppy market, one where there's no clear directional trend, prices oscillating back and forth without establishing clean higher highs and higher lows, buyers are less confident. They need more evidence. They wait for deeper pullbacks before committing. So in a choppy market, a market that is oscillating, all of that, the entry zone that I use is the 50 to the 618 retracement, the deeper zone, the zone where the less confident buyer is waiting after seeing more of the move give back before stepping in. Now, how do I know when the market is choppy versus trending? Because that is the question that decides which zone I'm using. And I want to be specific about this because it's not a gut feeling. There are 3 things that I'm looking at. First, the higher high, higher low structure. In a trend, each higher high exceeds the prior one. Each higher low holds above the prior one. In a choppy market, you start to see this break down. A higher high fails to exceed the prior one. A low undercuts the prior low slightly before recovering. The structure becomes irregular. The second thing that I'm looking for is the EMA cloud. Now, whatever EMAs you deem important, this is really a personal thing. Now, typically I'm using a 9, a 21, and a 44. All right, or a 9, 22, 44. But you might use an 8, 13, and a 21. It doesn't matter. Whatever EMAs is part of your strategy and how you trade, I want you to think about that whenever I mention an EMA cloud. Okay? Is price moving clearly above those key EMAs and staying there? If it is, it's trending. Or if price is weaving in and out between those key EMAs, failing at the top, but finding buyers at the bottom EMA, or just staying flat right in the middle, your middle EMA that you watch, for me, like the 21, staying flat inside of there, that is a choppy market. If it's touching from above and below and just going back and forth, that's choppy. And then third, the range of the swings. In a trend, the swings have consistent momentum. In a choppy market, the swings are inconsistent in size. Sometimes big, sometimes small, with no clear directional conviction. And now the confirmation sequence for a choppy market entry. It's the same concept as method 1 or a trending market entry, but it occurs deeper. So when price enters the 50 to the 618 zone, I am watching for the same signals: a slowdown in price and movement, absorption candles. Inside the zone, I want to see higher lows in an uptrending market or lower highs in a downtrending market. That is confirming that the deeper pullback has found buyers and they're stepping in. The stop in a choppy market entry: simple. Candle close below the 61.8 level on my trade time frame. In a choppy market, if price closes below the golden Fibonacci ratio, I no longer have a valid reason to hold the trade. The deeper buy zone has failed. I exit clean and then I reassess. And here's the most important thing I want you to take from this section. The tool is the same. The draw is the same. The difference is which zone you use. And that decision is driven entirely by one question: is this market trending or choppy? Answer that first, then choose the zone that you want to focus on. All right, method 3. And this one I think is underused by most Fibonacci traders because most people learn to use Fibonacci for entries and they stop there. But the same tool that tells you where to enter can also tell you where to take profits. And that is the secondary Fibonacci draw. Here's the concept. After I've taken my entry using method 1 or method 2, depending on if it's a trending market or a choppy market, I take a second Fibonacci draw. The same tool, but this time I draw it in the opposite direction. For a long trade, I draw the secondary Fibonacci from the most recent swing high down to the most recent swing low. The levels that populate are now above current price, and those are my target levels. Let me walk through this practically. I take my entry at the 38.2 retracement of the primary draw on a trending day using method 1. Then price starts to move in my direction. Well, I have drawn my secondary Fibonacci from the most recent swing high down to the most recent swing low. The 38.2 of that draw is my first target, target 1. That is where I take partial profits. The 618 of that secondary draw, that is target 2. And that is where the remainder of the position comes off if I don't have a higher target, or I take more partial targets and then wait for the higher target. Now, why do I use the 38.2 and the 618 specifically for targets? It's the same reason. They work for entries. These are the proportions where institutional capital has historically taken profits. The market's natural reward exhaustion tends to occur at these levels. Just as its pullback exhaustion occurs there, it's the same psychology, but working in both directions. And here is the discipline point that goes with the secondary Fibonacci. Once I have my targets drawn, I do not move them based on what price is doing in the trade. The target is the target. If price is running and it looks like it might go past the 38.2, I still take my partial profits at the 38.2 because that is the plan I made when I had a clear head. In trade decisions are made under emotional pressure. Pre-trade target levels are not. All right. This is a section that I think is the most underappreciated of everything I'm going to cover today because most traders know how to use Fibonacci for entries, and you might even know how to use it for targets, but very few know how to use it in the middle of the trade for staying in. Here's the rule. After I've taken partial profits at target 1 and at target 2, the remaining portion of my position stays in the trade as long as the 38.2 level of the current move holds on my trade time frame. As long as price does not close below the 38.2 on a pullback, I'm still in the trade. Still in, still letting it run. Why is this the rule? Because in a healthy trending move, whether it's a swing trade on the daily chart or a day trade on a 15-minute chart, after the first leg of the move, price naturally pulls back to establish a new higher low before continuing. In a trending move, that new higher low tends to find support at or above the 38.2 retracement of the prior leg. If it holds there, the trend structure is intact, the move is still valid, and there is no reason to exit the remaining position. And here is where the exit rule kicks in. If price pulls back and a candle closes below the 38.2, that tells me that the trend structure has changed. The prior swing low is being tested in a way that suggests the buyers are no longer defending that level strongly enough. I take what I have. Partials have already been locked in at T1 and T2, and I exit the remainder clean. The reason I love this rule is that it removes the in-trade guessing about when to take the rest off. You're not watching a trade and asking yourself, is this pullback too deep? Should I hold? Should I exit now? The 38.2 answers that question for you. It's already decided. You just watch and execute. If the candle closes above the 38.2, stay in the trade. If you get a candle close below the 38.2, go ahead and exit your runner. All right, the last piece, the Fibonacci extensions. And I want to start by being very specific about when I do and do not use these, because extensions can be drawn anywhere and drawn everywhere, and they become noise. I have one specific rule for when extensions come out. I use Fibonacci extensions only when price is at or approaching all-time highs or all-time lows. That is the only situation. Here's why this rule exists. In most situations, price has a history. When a stock rallies into a prior resistance area, that area gives you a natural target. The supply zone, the prior high, the prior consolidation range, those are your reference points. But when price is at an all-time high, there is no reference above. No prior supply, no prior resistance. The market has never been there. So what do you use for targets? That is where extensions come in. I draw the Fibonacci extension tool from the most recent swing low to the swing high and back to the swing low. The extension levels, the 1272, the 1618, the 2618, those project above the prior high, and they give me targets in uncharted territory. The 1618 extension, the golden extension, is the one that I give the most weight to. It's the same ratio derived from the Fibonacci sequence that appears everywhere else in nature and markets. So when price has no prior reference and is moving through new highs, the 618 extension is where I see the most consistent reaction. And the same logic applies at all-time lows, right? For a short trade or a declining asset. No prior demand below. Extensions project where the next likely area of buyer interest could form as price moves into new low territory. It's the same tool, same ratios, just projected in the opposite direction, below the prior low instead of above the all-time high. All right, traders, let me bring this all home, okay? This is your opportunity to take a screenshot if you want all the framework in one screen, okay? One tool, 4 specific applications. The draw is the same every time. The market condition determines which zones you use for entry. The secondary draw gives you your targets. The 38.2 tells you when to stay in and when to let go. The extensions come out only when there's no prior high or no prior reference price action below. The reason Fibonacci works, and I want to leave you with this, is not because it's mystical or mathematical in some abstract sense. It works because institutional money clusters at these levels and because human psychology gravitates towards these proportions consistently. When you draw these levels, you're drawing a map of where the most significant capital in the market is most likely resting. All right? All right. Hopefully, have y'all had time to get a screenshot of this screen before I open it up to live charts? I just want to make sure before I take it off of here that you've had the opportunity to take a little screenshot. All right, cool. Well, let's go to some live charts. And I want to look at not just high time frame or low time frame charts, but I want to look at both because, like I said, I use Fibonacci both for long-term trading. I use it for swing trades. And I use it for day trading. It is absolutely the most used tool I have, without a doubt. All right. So I'm going to start first, and I'm just going to use the ES futures chart here because we are at or near all-time highs. So it's going to give me an opportunity to use the extension tool. But it also is one that you probably trade or you reference every single day. So let me start here. The first question, and you're going to have to participate. Do you remember what the first question is that I need to ask myself? Is the market trending or is the market choppy? So if I'm looking at this weekly chart, this is a high time frame, right? I look at the most recent swing low to swing high. This is a bullish trending chart. All right. We are making higher lows and higher highs. It is in a bullish trend. So I right click. This is all done on TOS. Okay. That's the platform I use. So that's what I'm teaching on. You go to add drawing and you choose the percent right here. This is the Fibonacci retracement tool. I click on that. It is going to start at the bottom, this most recent swing low, and I'm going to pull it up to the most recent swing high. All right. The way you can tell if you have it ran correctly is that the 0 will be at the top and the 100 will be at the bottom when measuring an uptrend. All right? All right. Now, we asked ourselves the question, is the market trending or is it choppy? The answer was it's trending. So, the Fibonacci zone that I focus on in a trending market is going to be the 23.6 to the 38.2. This is the zone that I am looking for buyers to step in and then continue to the upside. All right. So on the weekly chart, because we're in a trending market, I want to look to buy a dip in this buy zone, the 23.6 and the 38.2. Now let's look at a name that is in a downtrend. And let me think of something that has been getting beat up. Is it PayPal? Yeah. All right. Same time frame chart, a weekly chart. But notice that this chart looks very different than the ES futures chart. This chart is showing a downtrending name. So on this chart, to measure a downtrend, I want to start at the recent or the significant swing high to swing low. All right. And same zone in a trending market becomes my focus, the 23.6 to the 38.2. In this zone, because we're in a downtrend, now your 100% is at the top and your 0% is at the bottom. We're in a downtrend. I am now looking for confirmation that sellers are overpowering buyers. So far on this weekly candle, I don't have that confirmation, but this is how you draw a downtrending Fibonacci retracement. All right? All right. Now let's go back to the ES futures chart. And I've shown you on a weekly chart. This is a higher time frame type of trading chart for me. But more recently, such as on a smaller time frame chart, the ES has not been trending, or it's not as clear, right? So I'm going to show you a 4-hour chart. And I'm going to show you that on this 4-hour chart, while we are making higher lows on pullbacks, we can't get above this ledge right here. Okay. We here's the all-time high. But we come up to the ledge, we fall back down. The ledge was down here. We're making some progress, but we're struggling here. Okay. So it is when the market is in a choppy, not clear direction that I want to focus rather than on the 23.6 and the 38.2, I prefer to focus on the 50 to the 618 zone in choppy price action. All right. So if I was looking at a 4-hour chart and I was looking for a buy zone that I want to trade for a day or 5 days, possibly. Okay. I'm going to look at the most recent move, and it's right here. After this sharp pullback, we started moving up. This is the most recent move. So let me show you how I would draw this for a smaller time frame trade. And I want to show you this was the range that I had measured, and it's an actual range that we traded off of at Simpler in the SPX room, okay? This range was measured. Here we established, or we started the move on the 8th of July, and we created a pivot high here on or around the 10th or 11th of July. Okay, that's the range that was measured. But I knew that we were in choppy market conditions. All right. So that meant my focus, rather than on the 23.6 and the 38.2, my focus shifted lower because the market was in chop. All right. And it gave me a buy zone using the 50 and the 618. You can see here when price pulled back into that zone, buyers stepped in and price rallied. In choppy conditions, my original or my zone that I would use in trending conditions did not work. Be right there. And you can see that price did not respect that zone. In choppy conditions, price often does not respect the 23.6 to the 38.2, but it does respect the 50 to the 618. And it is why every morning I look at a chart and I ask myself if we're chopping or trending, and then I make my decision based on that one answer, what Fibonacci zone I'm going to focus on for that day if it's a day trade. So let me now show you on the NASDAQ futures chart because it is much choppier. Wow. Do you see that? My NASDAQ isn't on here. That's weird. All right. Well, we'll put it back on there. All right. So let me show you what this looks like for the NASDAQ. Okay. I'm just going to go, oops, since we made the all-time high, okay. Yeah. Let's let that be in focus. This is Chop City right here. Everyone can agree we're just chopping. Price has moved from the all-time high down, then we come back up, we test it, we make a lower low, then we come back up, we test it, and it's just chopping. That's all that's happening here. So for the NASDAQ, my focus without a doubt on a day trading chart is the 50 and the 618. Now, on this pullback on the NASDAQ, if I'm trading this zone, I'm going to ask you a question. Was I stopped out of this trade right here? was I stopped out of this trade right here, trading this zone. That's right. I was not stopped out of that trade. And Renata asked, that's right, because it didn't close. No close below it, no stop out. Renata asked, couldn't you just measure any range that you wanted to trade? Sure. Let's say that I wanted to use this 4-hour chart, but I wanted to use this range here, all the way from this pivot low to the all-time high. You can use this range if you wish, right? All right, but let me talk about this. I can use this range all the way up until this candle right here. And the reason why I say until this candle right here is because when we closed so far below this 618, this bullish range is no longer intact. Okay? Then at that point, the range that I need to measure is a downward range because price broke below that 618. So then if I measure here, you will notice that we broke above the 618. So that is not the accurate range to measure. The more you do this, the more you're going to be able to see the most current range. See how the 618 was broken? That's not the range to measure. Like I said, I knew that this was the range to measure just because I've been using this tool every single day on every single chart for quite some time. All right. So this is the most recent accurate range that is intact because we've had no candles close below the 618. All right, Renata, does that make sense to you? I want to make sure before I move on from that concept. If you're new to using Fibonacci's, you might have to go through and check for 618 golden Fibonacci ranges to be broken. And you might have to do that until you get good at just visually seeing it without really drawing it on there. Okay? All right. So, to recap, when price is in a clear uptrend, and there's no doubt about it, let's look at Apple actually, because I know this thing is without a doubt in a clear uptrend. Okay. There's no question what kind of trend Apple is in. So, what zone, if I was measuring this move on Apple from the end of June to the most recent all-time high, what zone would I be looking at to trade on a pullback? That's my zone, right? That's right. Trending market. I run my fib. There it is. What about if you just wanted to day trade this move on Apple and you didn't want that entire range, right? This is a range. If I'm measuring 3 weeks of price action, it's a range that I'm going to use for a swing trade. If, though, I just want to take today's wicked, crazy, fast move to the upside, and I just want to use this range for tomorrow to trade, again, is it trending? Yes. This already worked once. This zone, you see the pullback right here, right? And look at the bounce you got from it. It's already worked once. This is the first zone I would be paying attention to. Trending. And I'm just measuring this rally right here for a day trade tomorrow. Okay? All right. Let's look at examples of how to use extension targets when you have no higher, in this case, price action, no supply, no resistance, nothing to use for additional upside targets, right? I've got the all-time high, but what if I need a target above an all-time high? If I want to swing trade the S&P 500 and I want to swing it out for a couple of months, right? I need higher targets. Because we are at all-time highs, this is when I will utilize the Fibonacci extension tool. And I'm going to take the most recent significant move. I'm going to now right-click at the bottom of that move, go to Add Drawing, and you use the percentage, but it has a move up. And that's your Fibonacci extension tool. All right, it is started at the base of this move. I go up to the all-time high, and I'm going to double click right here. Okay, now it's up to you. I'm going to tell you what levels I mark on extensions. I like the 1272, and it doesn't have to be an exact. I just go in between this 236 and 38.2 extension. 1272, 27.2. Okay, it's right about there. All right, then I definitely the golden Fibonacci level right there. And then a 100% of this move right here. Okay? That's how I use it for extension targets to the upside. Now, vice versa. And I'm going to go to a name that I know is at lows. Okay? But I need to go to a smaller time frame chart so you can really understand it. And that's SpaceX. Okay? We're going to use SpaceX. We have a pivot high, pivot low. This is the all-time low because this thing IPO'd at $135. 132.15 is a low, all-time low here. What if I need, what if I'm trading SpaceX to the downside and I need further targets to the downside? Well, I can take the most recent swing high, use that same Fibonacci extension tool down to the all-time low, double click it, scroll down, and the same way that I used it to the upside, I can use it to the downside to give me targets below. All right? But I only use the Fibonacci extension tool if price is at all-time high or all-time low to give me targets. All right? Cool. All right, so we have covered how to mark zones for entries if price is at or in trending markets. We have learned how to mark price or zones, Fibonacci zones for entries in choppy markets. We have learned how to use Fibonacci extension tool for targets to the upside or the downside if price is at all-time highs or all-time lows. Now, the other method I use Fibonacci for is to find secondary or use a secondary draw to identify targets. And this is something I do daily. Daily, I will do this. All right, so I'm going to go to a smaller time frame chart. And I'm going to show you how I would find targets upside and potentially downside on the ES futures chart for a day trading plan tomorrow. First thing I did, I marked the all-time high. I'm going to mark the pivot low or the down move right there to give me another upside target. And then I'm going to go into the most recent price action here on the 2-hour chart. And this isn't a lesson on how I find buy zones and sell zones. We've already did that. So if you haven't caught that session, make sure and check it out. If you're a member and you're here right now, you have access to that. So I know how to find my buy zones and my sell zones. But what if I want to use Fibonacci levels in between as targets? Whoops. I am going to use a Fibonacci draw in both directions to get those. Okay? And let me show you what I mean. Get your buy and a sell zone right here. All right. Now, how can I use Fibonacci to find levels to target? The range I have drawn is right here from this pivot low up to the most recent pivot high. I told you that I like to use the 38.2 and the 618 if I am finding targets, right? All right. We have established that ES is in choppy conditions right now. So I already know this 618 and this 50 would be my Fibonacci buy zone for tomorrow, right? But the 38.2 is a stop along the way. You can also use the 23.6, depending on how many targets you're wanting. If I only want 2 targets on the way to my eventual ultimate target or zone, opposite zone, if I only want 2 targets, I use the 38.2 and the 618. If I want more targets, then I will use the 23.6 as well. Okay? All right. So now I have targets from this sell zone on the way to the first buy zone and the second buy zone. Now, if you're wondering okay, but how can I use Fibonacci from if I have a sell zone here, right? And I want levels inside of this zone. Okay, there's a couple things that you can do. The first thing is you can draw your Fibonacci down right here. Yep, and we're above all of those. So what I like to do is just to do a hypothetical draw from the all-time high down to my buy zone right here. Okay. And if I were trying to create targets back to the upside from this buy zone, this is how I would do it. This is hypothetical. Price has not already come down here, but if it were to come down here, I would draw this to wherever that low is, and then I would mark the 38.2 and the 618 to give myself targets back to the upside. Because remember, these are Fibonacci levels here of the up move. They're giving me targets from the sell zone. But if I were trading this range back to the upside and I wanted targets, we have to hypothetically say that price turned down from here. Price came down to the buy zone, and then I would have my targets like that. All right. And so I know if I'm going long from this buy zone that I'm going to first target 75.95 and then 76.05 on the way back up to my ultimate target. Okay. I don't know where price will turn back down, but once the candles are there, then you will have the information that you need. Let's look at a name that possibly has that candlestick structure, and then you can see it in real time. Okay. Intel. Intel had a big sell off, right? It's pretty obvious if you were a part of this session that we did, I believe last month, that's a sell zone because you got that big old imbalance candle right there. And if you're wondering why price stopped right where it did, I want you to draw your attention back over here to the imbalance candles in and around this area, namely this one, but also this one. Okay, that's how I'm going to create a buy zone here using this imbalance move, and it has been tested. Okay, so the first part of any chart is to find where you want to be a buyer and find where you want to be a seller. The next part, though, is to find Fibonacci zones in between. Okay, so let's say we wanted a Fibonacci zone and on this down move on Intel, right? I would measure starting at the top because I'm measuring a down move, and this is for an intraday chart. And I'm going to draw it down to the most recent low. All right. You have to ask yourself, is the trend bullish or bearish? Is the trend trending or choppy? Just from a day trading perspective, so smaller look back, right, to the end of June. If you notice, you're making lower highs and you're making lower lows. This is a downtrending market, right? Okay. So my first zone to potentially go short from is actually right where price bounced. My second Fibonacci zone would be right here. Okay. You can draw them both on your chart because remember, you are going to be waiting for confirmation, or I am going to be waiting for confirmation before I just take the trade. But I have two Fibonacci sell zones. Let's say I was trading Intel, though, from for a swing trade, because this is a buy zone on an intraday chart, but it's also, I'll show you. Woof, I don't know where I put it. It's also a buy zone on a daily chart. Okay? You see the inside and up, you see the buy zone on my chart, right? Okay. So if I'm trading this intraday, I showed you the two zones you could possibly go short from. But if you are looking at this on a daily chart, this isn't so much trending as what it is chop. Do you see that? The amount of time you want to be in the trade tells you which time frame chart to look at to assess if the trend is trending or chopping. And this is just back at the bottom of a choppy range that Intel has been chopping around since, what's that say? 1st of May. Okay. So if we're in a choppy market and the most recent move is down, which zone would I look to go short from in a choppy market? Which Fibonacci zone? The 50 and the 618, right? Okay. Now, but I can also use the 38.2 as a target. And if you want another target on the way to this zone, use your 23.6. So a trade on Intel for a swing trade would look like this. I would go be a buyer here and trimming with a target here, and potentially looking to go short if price rallies back to here. And then what am I going to have to do? Well, I'm going to have to be hypothetical again, because these Fibonacci levels are for an opposite draw. So let's say that this is the low that's put in, and price has rallied to my sell zone. Then I use the new Fibonacci levels for targets. Okay. And now I'm short from here, and I'm targeting 113 and 107 and a half on the way back to 101 by 92. Do you understand? Renata says, couldn't you also measure one candle on the 2-hour, then go to even lower time frame, 3 or 5 minute, to set bullish targets? So honestly, Renata, you wouldn't, I mean, if you're on a 2-hour chart, right? You're still a day trade. This is a day trading chart for me. Okay. And you're measuring this move right here. It doesn't matter if you're measuring this move on a 5-minute chart or a 2-hour chart, you're still measuring that same range. And it's going to give you the same targets regardless of the time frame that you're measuring it on. Does that make sense? I wouldn't measure for a day trade. I wouldn't use this whole range because it's just too much range for a day trade. I want to use 1 or 2 days worth of price action. Something that makes sense like this pivot high to pivot low makes complete sense. But whether I look at this move on a 2-hour chart or a 5-minute chart, it's still the same move from pivot high to pivot low. Okay? I would still measure the same move because that is the most recent significant move. So don't worry about switching your time frame charts to be that precise. Just measure the significant move on, for me, a 2-hour chart for a day trade, and it's going to give me targets to the upside. Okay? All right. Let me pull over the chat here, and I'm going to give y'all an opportunity to ask any questions that you might have about how I use Fibonacci for entries, how I use Fibonacci for targets, and how I use Fibonacci to stay in trades. That's one thing I didn't show you. So let me pull up a recent or just a hypothetical trade. Sorry. On SPX. We definitely had enough swings in price action as of late on SPX to show you plenty of opportunities here of when to stay in and when to get out of trades. So let's look at SPX and today's price action actually. All right. So in today's price action on SPX, we had some opportunities to be short, okay, from a sell zone. And if I am short from this sell zone, and I have made it to, and in this case, it was 2 targets down here, okay? And I want to stay in the trade using the Fibonacci technique. Okay. I'm in this trade. I'm short. I've taken profits at 2 targets. And we get a candle that closes above the 38.2. I exit the remainder of my position. Okay. Let's say that you're in the trade from here and you catch this big move right here. Okay. In the trade from here and you caught the move and you're in a runner type position, I want to stay in as long as the 38.2 holds as resistance and I get out on the candle that closes above the 38.2. I've taken the trade from here to here. I've collected my profits and I want to stay in if the trend wants to keep going down. But once price gets above that 38.2, it is a telltale sign that price is probably reversing. And that's exactly what happened there. Okay. Let's say I'm in the trade from the low down here, which was a buy zone. And I've ridden it to the top right here. I want to stay in my runner position as long as the 38.2 holds as support. There's no candles closing below the 38.2. I stay in the runner position and it cash settles right here. This is a way that I use the 38.2 to stay in positions. Now, I will say, for the most part, for me, intraday trading and scalp trading, I do not use Fibonacci to stay in my runners. I use candlestick structure. But for my swing trades or longer term trades, without a doubt, it is it is a thing for me. So let's say that you're in Apple, right, from the lows to the highs. This trade is valid long term as long as price remains above 307.90. I look for this trend to continue to the upside. No need to get out of the trade. Okay. Let's say that I wouldn't have been, but let's pretend that I was short Apple right here. All right. I would want to stay short as long as price closed below the 38.2. But once it closed above the 38.2, telltale sign it's probably reversing, and I would be stopped out right here on this candle. Okay. All right. All right, guys. I don't see any other questions that y'all have, and we've been at this for an hour and 10 minutes. I want to respect your time. So I'm going to hop off of here for now. Thank you so much for joining me this evening. Thank you for being a member of the channel. I hope you found the content valuable. This I will be on vacation from tomorrow until August the 1st. So if you don't see videos coming out, you know why. I'm taking a vacation to celebrate my anniversary, but I will be back in August, rip roaring and ready to go with all of you. If you're not a member of the Simpler Trading community and you're not in the SPX room trading live with me and the absolute best community of traders out there, then please, please, please come and join us. We trade live each day, and we have a great time doing it. Super important. Golly, trading can be very lonely. And if you don't have a great group of community of traders to trade with, I couldn't even imagine doing this every day. So come and join us at Simpler Trading. We would love to have you. And yes, thank you for the anniversary wishes. I'm going to enjoy my time. I'm going to see